Okay, folks, welcome to Market Wrap for the 27th. Okay, last night with members, I mentioned that we were going to do an options trade on Twilio, and we did do that. And we're going to talk a little bit about that trade right here, right now, because they have announced, and their earnings were very, very good. The problem is that their forward-looking guidance was not so good. So we'll do a deep dive with regard to the trade, where we stand, are we happy, are we sad? And we will also talk about the economic data that was released today. We'll then talk about the closing price action of the markets. And then with members, we're going to segue over and into the extended cut of our market wrap, where we discuss our positions and strategies with regard to those positions moving forward. So if you're not currently a member, please sign up for our 14-day free trial offer. It'll be posted in the members area. Okay, so let's talk about Twilio. The market makers had expected a move on Twilio of $22.63. So what we did is, with that in mind, is that we made a calculation of, okay, what we want to do is let's go to the closing price action chart first. This is a weekly chart of Twilio. And what we did is exactly what we did with Facebook. I'll post a video to the Facebook trade showing you how a strangle works. That's the sale, not the purchase, but the sale of a deep out of the money call and a deep out of the money put with the same expiration date. In this case, they expire on Friday. Now, in this type of trade, given the fact that we're the casino and not the gambler, we want as little price action as possible after the earnings announcement, whereas the gambler wants as much volatility as possible, ideally going in the direction of where his contracts are positioning him to profit from. So in the case of Twilio, a few factors came to mind where we decided, okay, where are we going to place these strikes? Well, one is that Twilio is a very expensive stock. So right off the bat, we want to make sure that we stay very far away from where the stock is poised to close on the day as possible, yet still get some premium. So in the case of Twilio, it closed out the day at $345.66. The market makers were expecting a move of $25, between $24 and $25 on earnings. And so we took out our probability calculator, we took a look at the technicals, and we took into consideration the market maker moves. And you may be asking, did you take into consideration the $375 price target that some brokerage put on the stock only a week ago? No, no. That gave us zero help when it came down to where we were going to place our strikes. What we did is that we took the market makers move and we juxtaposed that relative to the support and resistance levels that we have on the stock. So on the call side, we went with a 395 call strike. On the put side, a 305 put strike. Now, the market makers at worst, a $25 anticipated move. When we opened up the trade, we were about $45 in our distance away from where the shares were trading. So lesson number one to trading strangles into earnings: don't get greedy and know the stock that you're trading. Leave yourself a wide berth, because this is not a game of hitting home runs on every single trade. No, this is a game of consistency. So now let's take a look, keeping in mind, focus on the 305 strike, because after the earnings report today, that strike got tested. So here you have the after hours price action. You could see initially the knee-jerk reaction, which I always like to say is usually the wrong reaction. We traded all the way up to around $368 a share. That's because of this report here. Beautiful numbers, beautiful. The problem is those are rearview mirror numbers. Then what came out? Forward-looking guidance. And it was not good. It was not good. The estimate for forward-looking EPS was a loss of 7 cents, they're going to range between 23 and 26 cents per share loss going into next quarter. And looking at their sales, they guided up on sales. So what that tells me is that their margins are under pressure. The business is good. It's solid. Let's get back to the trade. So now we know the whys behind why we have this major drawdown in the after hours session. We hit a low of 296.50. Remember, our strike is right here at 305. Could you imagine if we had gotten greedy and we kept our strike up here at 340 or 320, which is in the ballpark of where the market maker's move was expected to have the shares trade down to if they were going to trade down at all? We would be sitting with a big, fat, bloody loss right now. Now, as it stands right now, I think that tomorrow we're going to open up at around the 305 range. And you may be saying, well, doesn't that mean you realize a loss? No, it doesn't. Remember, we were paid a premium of $2.92 per contract. So you needed to deduct from 305, let's round it to $3 to keep it simple. I'm not that bright. So our basis cost is going to be around $302 per share. So if we open up at around 305 in that neighborhood, we could still book a profit tomorrow morning as the implied volatility gets crushed on the options and gets really crushed if you see a midday counter trend rally. We will not take on these shares. We will not have these shares assigned to us on Friday. Now, what we might do as well is say, okay, we have a big profit up here. It's hard to see. But up here is our call side strike. I can close that out, book that profit for about a penny, less than a nickel easy, and roll that all the way down to about here to 341. We won't get paid much. We have to roll it down lower. But we'll use a probability calculator to help us out where we're going to decide to roll that strike down to if we decide to do it at all. So we'll manage the trade. I'm not worried about it. We're bouncing back here a little bit, but it's not going to be a good day tomorrow. But net, the reason why I'm not worrying too much is because we did not get greedy and we did not bet the farm on this trade. It's all about the consistency of generating cash flow. Let's get to Microsoft chart. Okay, so Microsoft reported earnings, and they were blowout numbers, really, really good numbers across the board. Nothing bad to say about Microsoft in terms of their fundamentals. I think that the shares are going to move up higher. I caught some flack yesterday because somebody didn't like the fact that I've been saying that Microsoft is someday going to be a short. And it is going to be. Not right now, but we're very close. Because as I mentioned last night, you take a look at the quarterly chart, you have RSI at 96.33, and it's going up higher. I have no delusions of grandeur here that this stock is not going to proceed up higher. We're probably going to see RSI before all is said and done at or above 80 on a daily time frame. It's at that point in time where I will begin to look to short Microsoft just as we did Tesla. Tesla, great numbers. It rallied, but we've shorted Tesla twice now to the short side in the past couple of days. Once profitable because we closed out the position. The one we're currently in is slightly profitable, but it's still open. We don't count our chickens before they're hatched. We'll talk about Tesla in a moment. So Microsoft, great price action, great volume. This is a stock that wants to go higher. If you short it right here, right now, you do it at your own peril. And you may be saying, well, why did you short Tesla? Well, simple. The reason why we shorted Tesla the first time yesterday is that we were trading above the third standard deviation Bollinger Band with RSI above 90. That was unsustainable. Take a look at it on an intraday basis. We use a 2-hour chart. This was absolutely bananas. You knew you were going to get a pullback. But to think that the stock was just going to collapse is ridiculous, very foolhardy and reckless. And we booked profits. We didn't have delusions of grandeur. So when they rallied it back today, we put an advanced order back out. RSI went back above 90. Intraday didn't close there. And you could see we faded on the day. Does that mean that Tesla is going to collapse tomorrow? No, it doesn't mean that. It could go higher tomorrow, but we didn't get aggressively short. If it does pull back tomorrow, great, we're happy. We'll make a few bucks. We'll move to the sideline. We'll look for the next trade. If it continues to press these elevated RSI levels, then we're going to look to add to the trade. And the type of trade that we put on here is what you call a bear put spread. What does that mean? It means that we bought a deep in the money put option and we sold a deep out of the money put option. The premium that we generated from the sale of a put option helped finance the purchase of a put option. So if we see Tesla grind up a higher here, we could still make a profit on the sale of the put that we sold. And if we reach nosebleed levels, as we still are really, but we can go higher on RSI. If we close with RSI above 90, 91, you know what? I'm going to take that profit from the sale of the put, because we are on that side, the casino and not the gambler. We're going to put that in our pocket and we'll be net short of Tesla. Members, we're going to talk about this trade a bit more on the back half of this commentary when we go into our current holdings. Let's talk about economic data. So economic data today was not good. Durable goods came in with a negative read. Orders declined in September, pulled lower by autos and planes. That's why you're seeing such weakness on Boeing shares. But I will point out that the result was not as bad as what was expected. This is nuts. Trade in goods. This is our trade deficit. $96.3 billion. Back in the early 90s, if we would have had a number like this, the trade deficit moved the market. Now it doesn't. And look at how much our trade deficit grew versus last month. Bananas. Here, U.S. trade deficit in goods soars 9.2%. Folks, this is just so bad. Now, tomorrow, we're going to have initial jobless claims. We're going to get the GDP read for Q3. Moving on to bond yields. I had mentioned last night that I was suspect of the price action on the bond yield, that it may have been a setup for a bear trap, that we might pop back up higher. We did not. We gapped lower. And it should be no real great surprise, because when I spoke about the TLT, the 20-year bond ETF, I was quite bullish. So we had broken out yesterday. We recaptured support. Today, we just gapped up higher. Now, 148 is resistance. You could see that we faded off that mark today, but the TLT looking pretty good. Volume, very good. The chips, daily time frame, gapped up higher. New all-time highs today, folks. And for those of you not familiar with the phrase stagflation, you've heard of it, you don't know what it is. Well, when you see durable goods orders coming in negative, yet your exports, your trade deficit is expanding exponentially, driving up inflation, that is stagnant growth with inflation, and that's why you're seeing the tips, Treasury inflation-protected securities, rip. The dollar, it opened up lower, but it did reverse to close off the lows of the session to just down a penny. This is the dollar bull ETF. Down volume, very light. So we remain in what I believe to be a bear flag setup. The VIX surged today. We spoke about this last night. You can go back to Market Wrap last night. I mentioned that, when you get the VIX down in the low to mid-teens, that's pretty low. And when the VIX is low, you got to go. You got to think about booking some profits on your longs. And if you begin to see lower highs and lower lows, which are technical breakdowns on indexes, stocks, or whatever you're trading, well, then you may want to look to go to the short side. So the VIX looking pretty darn good. Stokes hooking up. Remember last night we spoke about the Stokes. They were declining. Then they went neutral. And as of last night, they began to hook up. Today, you got follow through. The Dow transports. I mentioned this last night. They were very, very extended. You cannot expect this to continue. This rally was unsustainable. Sure enough, you got a greater than 1.33% pullback on the session, and we're probably going lower. Down volume, not too bad. Stokes rolling over. We're losing momentum now. MACD histogram clearly losing the momentum. The S&P 500 daily chart. Last night, I had mentioned that we were seeing some topping action, meaning indecision bars, 2 of them within the past 3 days. Doji star formation on the 22nd. Then on the 26th, a fade, a filled candlestick. Today, a new daily lower low. This is not a broken chart. So this does not scream to me, get short the market. But what does concern me, where I am net long of the market, is the fact that you've seen up volume bars decline very, very steadily. Yet you get a down volume day and we're right back up to the moving average. That's a distribution day. The Dow Jones Industrial Average, same deal here. Filled candlestick yesterday, a rollover today. We broke multiple daily lows today. Volume rose. The Qs, they eked out a gain. These Stokes imply that we may just get another bump up higher. You may be saying, why are they bucking the trend relative to the S&P 500 and the transports and the Dow Jones? The reason is that you have a technology-laden ETF. And as yields pull back, that helps technology, and that's why you're seeing technology do pretty well. Yes, we did fade on the day. This is not great price action. You did not have great price action yesterday. You had a filled candlestick. Volume on both days yesterday was good. Today was okay. It was about average. The small caps, of which we are short. Now, we got a continuation breakdown today, down 1.84%. Why are the small caps getting beaten up? Simple. When you see durable goods orders come in with a miss, negative, inflation on a tear, and yields pulling back, that's a sign of an economy that is not expanding, but one that may just in fact be contracting. We're going to get GDP numbers for Q3. The Atlanta Federal Reserve has been ratcheting down those expectations for weeks now. The banks. I was asked, what do I think about shorting the banks? I wouldn't short the banks. While this is not a good-looking chart, I wouldn't short them yet. This is not a broken chart. The reason why they pulled back today and were distributed is because you saw yields pull back. I wouldn't buy them yet, but I wouldn't short them. Technology. The market sends you signals. Spinning top formation, filled candlestick, another filled candlestick, all signs of a topping action today. Bearish reversal bar. Unlike the Qs, XLK was unable to eke out a gain. It didn't trade as poorly as the small caps or the Dow names, but closed down nonetheless. Volume rose. Consumer discretionaries daily chart. Last night I mentioned this was a sign of topping action. Sure enough, more topping action today. Volume is good, but you got to take a look at volume in conjunction with the price action. When you're trading higher in the day and you lose most of those gains, a lot of that volume was selling. Let's take a quick peek at a 15-minute chart. You can see, look at this selling pressure yesterday on fairly good volume to the close, to the downside yesterday. Today, big down volume into the close. So beware. Understand that all is not what it seems when you see an up day on a daily time frame along with strong up volume. That's why we like to use candlesticks and not just a line chart or a open, high, low, close chart. Energy rolled over today, down nearly 3%. This is a signal of traders getting concerned about a contraction in the economy, folks. Emerging markets down over 2.33%. They did it on volume. So even emerging markets are under pressure today. So avoid. I'm not seeing a trade here. I like the fact that the dollar is weakening up a little bit, or weakened up today, but it certainly didn't help emerging markets, which it usually would do. So let's wait for a support level to get hit. Then we'll look at emerging markets. Gold. Okay, so we saw a bullish key reversal bar today, meaning that we were down, we closed positive on the day and right near the highs of the day. Love it. We held support at 1790. Great. We were stopped dead right at critical resistance, psychological resistance at 1800. I think we're going up higher. We're loaded up with the gold mining stocks, silver mining stocks, silver. So we're going to be looking to make adjustments to our portfolio of mining stocks. And in fact, let's move on over to the strategy session with members. Okay, let's kick things off first with the gold mining stocks, NUGT first. And I'll tell you what I'm loving here. Okay, members, let's head on over to our strategy session in the members area. And if you're not currently a member, sign up for our 14-day free trial offer. What are you waiting for? Get 14 days free. Get access to our premium analysis, the week ahead commentary, our strategy session on market wrap, our top 10 stocks under $10, the members forum. Get real-time trade alerts, both options and equities. Get a stock chart request. That's where I review the symbols that you want me to review. So again, folks, get our trade alerts. One-to-one engagement. Scroll on over to our checkout page. There are a bunch of FAQs for us to answer. Schedule a call with me. Have a coaching session. I look forward to seeing you on the other side. So please do it now.